Risk management. It is the pre-calculation of the amount that can be lost while trading with the existing capital, the measures taken, and the work done to minimize or eliminate this amount. People who do not manage risk well when trading on the stock market have a very low chance of success. According to some sources, technical analysis is 10%, basic analysis is 20%, psychology is 40%, risk management is 30%. Now let's see how risk management is done. First, let's look at the amount we need to earn in order to reassess the amount we lost. We need to earn 11% for 10% loss, 25% for 20% loss, 43% for 30% loss, 67% for 40% loss, 100% for 50% loss. I mean, it's easy to lose, but it's hard to earn. Now, you're looking at the chart of losses that can happen when someone with a $10,000 balance does random risk management. After stopping 10 times in a row, the remaining amount is approximately 1% of the starting capital. The profit that this person needs to make in order to reach the starting capital again is approximately 10,000%. As you can see, this is impossible. Now, let's examine the chart that occurs when a person who does 10% risk management stops 10 times in a row. As we see here, a person who constantly stops with 10% of his balance loses approximately 65% of his capital as a result of 10 transactions. The replacement rate for this loss is 185%. Now, let's examine the chart that occurs when a person who risks only 1% of his balance in each trade closes a trade at a loss 10 times. The loss that this person made as a result of 10 transactions is approximately 10% of the main balance. And the replacement rate for this loss is 11%. Let me remind you here, %s is not our stop distance, it is % of the amount we lost in our balance. So, no matter how we adjust a stop distance, the amount we lose should always be the amount we're willing to risk, and it shouldn't change. Now let's see how to do this. Let's think we have a balance of $10,000. Let's say we are willing to lose $100, so 1% of our principal on every transaction. And let our stopping distance be 4%. The amount we need to trade is 10,000 divided by 4 equals $2,500. That is, when we enter the transaction with $2,500, even if our stop distance is 4%, the amount we will lose is 1% of our balance. Let's give another example, this time our stop distance is 10%. What we need to do is 10,000 divided by 10 equals $1,000. So we will have to trade with $1,000. Even if our stop distance is as big as 10%, our loss will be 1% of our main money. What we did was risk management where we risk losing 1% of our management balance, but what about people who are willing to risk more than 1% of their balance? Of course, it will multiply the result with how many % risk ratio there is. For example, 10,000 divided by 10 equals $1,000, that's 1% risk. The person taking the 2% risk will multiply the $1,000 by 2. The person taking the 5% risk will multiply by 5. So if the person with a $10,000 balance wants to risk 2% of their balance, they're willing to lose $200. In a 10% stop trade, he should trade with 10,000 divided by 10 equals $1,000. $1,000 times 2 equals $2,000. When we look at the tables we examine and the calculations we make, we see and understand how important risk management is. Please try to make the best use of risk management and minimize your losses when trading in these markets. If you liked the video, you can support the channel by subscribing and liking the video. See you in the next videos. Take care of yourselves.